Hello, everyone. It's Felipe here. Happy Monday. Hope everyone is doing good. So, as you know, I'm here to keep you up to date with current market news and teachings. This is in no way, shape, or form financial or investment advice. This is for entertainment and educational purposes only. So, I'll go ahead and jump right into it. So, basically, what I've come across recently in terms of economic indicators and so forth. So here we have the United States Purchasing Managers Index, which is basically an indicator of like economic manufacturing, like the trend of manufacturing. So basically gives you an idea whether manufacturing is trending upwards or is trending downward and so forth. And something interesting about this indicator here is that typically when it goes below 48, it's usually a sign of manufacturing basically going in a downward trajectory. So basically, manufacturing is slowing down in the United States. This is what this is basically saying. So here you can go back to 2000s or the early 2000s when the dot-com bubble happened, all the super high expensive tech stocks that went crazy, and then suddenly they all went crashing down. I believe Amazon lost something like 90% of its value during the dot-com era bust, right? So here you can see the manufacturing itself slowed down during that time, crossing again that 48 level. And here again, during the 2008 crisis, right? Manufacturing again took a big dip. And in 2020, and now we're kind of seeing again a downward trajectory in the PMI. So this could potentially mean that manufacturing in the United States is slowing down. And why I bring that up, because that's kind of like why I was going into the whole semiconductor market, because basically the semiconductor market, like all these chips, right, that are usually in everything these days, again, are similar to this, where they kind of when they sell less of those, that basically means manufacturing in the country is down. And currently we're seeing that issue in the semiconductor market, but globally. So potentially global manufacturing is trending downward. So that is interesting because recently we've seen the craziness with gold and silver prices, which makes no sense to me considering manufacturing is down. And I'll go into that a little bit later. Another thing is US subprime auto delinquency rate is up. So subprime, basically unworthy borrowers that purchase vehicles, delinquency rates have increased pretty dramatically recently over, after the dot-com, not the dot-com, but after COVID lockdowns, it went pretty low, which basically correlates with, the downtrend in interest rates, right? Down here, interest rates were near zero. People were taking out more loans and so forth. Now interest rates are going up. People are taking less loans. And we're seeing now the subprime auto delinquency rate currently go over 2008 level. That's interesting to see. And then over here in 2008 levels, you can kind of see when the whole crisis occurred, Federal Reserve drops down interest rates, and that basically stimulates all markets. And you can see it here in a way, the subprime auto market. And recently, of course, the Federal Reserve had to lend out a lot of money via the discount window with what occurred with the banks to kind of tame the fears. And they did do that in terms of, it doesn't seem to, the market is not panicking as it was when Silicon Valley Bank announced they were going bankrupt, kind of set a panic shortly after. Fed steps in, injects a bunch of money into the banks via the discount window, which is a way the Federal Reserve allows banks to take loans from them. The lender of last resort, the Federal Reserve, So it's interesting to me that, they've lent out that much money recently, which is pretty insane. This is like a rocket ship. It surpassed the 2007 levels. So, I mean, it's not a crisis, but it kind of looks like one in terms of what these indicators are basically showing, right? So I find that super interesting to see. So let me swap over here in a second. And I find this stuff interesting. Apple recently advised that Mac shipments for, I believe, iPads, Macs have dropped 40% recently, which then again, this correlates with the whole semiconductor market because semis are used in these laptops and in iPhones and iPads and so forth. So that's kind of like what I've been pointing out. If less of these semiconductors are being sold, if their companies are marking down their inventory, this means that a lot of other industries are going to be affected by it as well because they utilize these chips in their products, right? So Apple Mac shipments fell 40% in the first quarter of 2023 compared to last year. And then it just goes into them losing some market share, nothing too crazy. But this is, again, going throughout the whole industry, right? So all five of the largest computer makers, Apple, ASUS, Dell, HP, and Lenovo, saw double digits drop in the first quarter shipment, reflecting weaker demand and persistent inventory woes. So basically their inventory is accumulating. They're not being able to sell these products, and then they're having to mark down their inventory, which is then again causing these declines, right? So basically, Mac revenue fell 28% year over year during December's quarter. Apple CEO Tim Cook said that at the time that the challenging macroeconomic environment affecting iPhones, Mac, and Apple Watches sales. So they're seeing a reduction in iPhone sales, Mac sales, Apple Watch sales, and so forth. So basically, consumer discretionary spending seems to be slowing down because people are buying less of these goods, right? They're cutting back on spending. This is what it leads me to believe, basically. And as I was basically going into the whole global semiconductor market and how this basically affects everything else in a way, because this is basically the most important and the most important commodity in the world is semiconductors. If you think about it, they're anything that has to do with technology or the improvements of technology or adding technology to it uses these things. So a slowdown in this basically can potentially say that, hey, all other industries or majority of other industries are going to be affected in some way. So TSMC, which is Taiwan Semiconductor Corporation, again, advised that they have seen the revenues declines, which I believe they haven't had a revenue decline in like 4 years or something like that. So their revenue fell over 10% on both sequential on year basis. So for March, so revenue went down, which currently they announced 4.7 billion for US for 2023, down 10.9 on the quarter and 15%. So revenue is down 15% from a year earlier, which this basically shows again a downward trend in these companies' earnings. It's been trending downward, going lower and lower and lower, showing that basically semiconductor sales are going down, right? So, and then this is, not only this company, but I was going into Samsung having the same issue. Macron actually had a big loss. And here you can kind of see that they also specify other companies such as Specialty IC Foundry, Vanguard International Semiconductor, saw its revenue fall 14.5%, hit a 12-quarter low. And then UMC, which is another company, previously stated that wafer shipments will fall 17 through 19% sequentially in the first quarter, when the foundry overall fab utilization rate will drop to around 70% from 90% previously quarter. So this is maybe companies kind of adjusting to the reduction in demand. So they might potentially be cutting back on what they're producing in terms of these chips to bring prices up, kind of balance the supply and demand issue. But this is, again, an ongoing issue throughout the industry, not just affecting this one company. As you see, it's affecting a lot of companies in the sector. And Federal Reserve basically finally comes out admitting, hey, we're going to have a mild recession towards the end of the year. They're very careful. They treat the market like a baby, right? Mild recession, make it sound very mild. So basically, they're advising that the banking crisis that occurred in March is going to lead to a recession later this year. They're advising that the bank sector is sound and resilient. I mean, it does seem so, being they injected a lot of money into the sector. So that would definitely be the case, considering the amount of money they pumped into it. So basically, they're advising a mild recession. So the staff projection at the time of March meeting included a mild recession starting later this year. I love the verbiage they use. It's interesting. So they're also, the federal officials expect gross domestic product growth of just 0.4% for all of 2023, which typically, as per definition, it takes two consecutive negative gross domestic products prints to, as per definition, call it a recession, which we had last year, but they changed the definition last moment. But supposedly that's what is a recession. But if they're saying here that they're expecting GDP to, in a way, grow, it kind of contradicts what they're saying in terms of that there's going to be a recession, right? So it's very interesting that I mean, in reality, they don't really know what's going to happen. No one's going to know what's going to happen. Even the Federal Reserve officials have no idea what's going to happen. They're doing the best they can with the tools that they have, right? But in reality, they're sharing their opinion and what they think might potentially happen, right? Because at the end of the day, no one knows what's going to happen. So the Federal Reserve came out again hawkish, basically stating that they plan on increasing rates another 25 basis points, which is a 0.25% increase in the next quarter. Or basically they seem to still have a hawkish stance, meaning that they're still worried about inflation because it is not at where they want it to be, which is 2% inflation rate. It's currently, I believe, at 5.1%, the recent prints. And they're advising they're gonna basically, they have a hawkish stance until that actually occurs, which basically means they're gonna continue, or they're talking about continuing rate hikes, and rate hikes are not good for the market. It causes lending to become more expensive, and it causes borrowing to become more expensive, actually. So basically, rates officials stress that more rates increases are necessary to tame inflation. Because if the Federal Reserve, honestly, they pivot and they start dropping rates again, it's going to become inflationary. The issue is still ongoing. There's still a war in Ukraine. All of the issues that are causing the inflation are still ongoing. So they basically have their back against the wall in terms of what they can do with inflation, right? Because otherwise they might potentially let inflation get out of control if they start lowering interest rates. So yeah, inflation, the current rate is as of the recent print, 5.6%. And then we've seen like a pretty interesting rally recently in the markets, and I'm considering this to be a BS rally because it seems like a lot of speculation. And the reason why I say that is because, you know, I'm very interested in the crypto world and all that, and I love learning it, but I don't agree with the mining companies. The mining companies that basically have these farms with a ton of GPUs that are mining these cryptocurrencies, and basically they're money pits. They consume massive amount of energy and electricity, and then you can just look at their finances, which I have, and I've made a video on how bad their operating losses are in terms of electricity costs, right? They consume massive amount of electricities. So these are high operating cost businesses. And they basically leech off of shareholders because they're constantly diluting their shares, selling more shares on the market to get more money to fund their operations. Because basically what they do is they mine cryptocurrencies, for example, Bitcoin in this case, and what they produce of value is that Bitcoin that they hold, and then they lend out for certain profit, right? But their whole business plan is behind the value of Bitcoin or whatever cryptocurrency it is they're mining. But those high cost energy bills are like, they're a huge crutch. I'm just surprised a lot of these companies are still around, considering the massive operating costs they're running. But it makes sense considering all they do is dilute shareholders, dump a bunch of new shares on the market to continue operating. I think they're literally a vampire leeching blood off of their shareholders. I don't understand this business and don't understand why it is still around. And the fact that these companies are rallying are very interesting to me and giving me an idea that this is basically a speculator rally, right? And then silver prices, I was going into the PMI, which is basically an indicator of the trend of economic manufacturing. And silver and gold are used in manufacturing. They're used in all kinds of industries. For example, solar industry uses them, car industry uses them, technology industry uses these metals, right? They conduct electricity and so forth. So it doesn't make sense that gold and silver prices would be going up considering manufacturing is slowing down and inflation is not at the moment the issue that kind of supports the narrative of these metals increasing in price, because they are inflation hedges, right? When inflation is a problem, things such as gold and silver go up in price because they're considered inflation hedges. But it's not like after the 2008 crisis, where the Federal Reserve was then dropping rates and stimulating the market. And in that case, gold and silver prices went ballistic. That made more sense because Federal Reserve increasing rates is deflationary. They're fighting inflation, so inflation is coming down. So that narrative doesn't make any sense for these prices in gold and silver, as well as the fact that manufacturing is trending downward. Because believe it or not, manufacturing influences the prices of gold and silver in a way because they're used in a lot of industries for manufacturing purposes. So with all that I shared with you, basically that is kind of some of the stuff that I'm seeing. And I'll leave you with this. I'll leave you guys with a market quote. So times change and we change in them. Change is indeed the investor's only constant. So time change and we change in them. Change is indeed the investor's only constant. And I'll throw some economic information your way. Basically, the principle is simple, right? The wider the swing in interest rates and the longer the bond, the more the value of the bond can go up or down on an interim basis before maturity. So that's what I've basically been saying in terms of what was causing the banks to lose a lot of money because they were holding a lot of these long-term bonds, and an increase in interest rates basically it's bad for the bond markets actual bond value, right? They do pay more interest rate, but their actual value fluctuates and goes down when interest rates go up. So thank you guys for watching. I appreciate that. I hope I share some valuable information with you guys today, and I'll talk to you guys soon.